Today I would like to analyze Whirlpool Corporation, one of the largest home appliances companies in the world. We can see here the stock price is down around 65% in the last 5 years. So we're going to take a look at the financials to find out if it's a good buy right now. The first one we can recognize is a market cap of 4.83 billion US dollar. This makes Whirlpool the 13th largest home appliances company in the world by the market cap. We also have a dividend yield of around 3.99%, which we can see here didn't have a very good growth in the last 10 years. Now we're going to take a look at the financials. The first thing we're looking for is revenue growth in the last 5 years. We want to invest in a growing business and not a declining business. So in 2020, the revenue was around 19.46 billion US dollar. This was a decline around 5% from 2019. Then in 2021, we had a good growth around 13%. In 2022, we had a strong decline around 10%. Then again, 2023 is a decent decline around 1%. In 2024, again, the strong decline around 14%. So overall, the revenue growth in the last 5 years was not good. So it's not a check here, and we don't like to see that. The next thing we're looking for is a free cash flow growth in the last 5 years. The free cash is very important because it can be used to pay the dividend, to pay the stock buybacks, to invest in the business, and also to pay back the debt. So in 2020, the free cash flow was around 1.09 billion US dollar. This was a growth around 56% from 2019. Very good. Then in 2021, we saw the strong growth again, around 51%. In 2022, we saw the strong decline, around 50%. This is something we don't like to see. And in 2023 is continued with the decline around 55%. And then in 2024 we had a small comeback with a growth around 5%. But overall in the last 5 years, I think the free cash flow growth was very bad actually. So it's also not a check here, and we don't like to see that. The next thing we're looking for is a free cash flow yield over 4%. This can also tell us about the valuation of this company. The higher the free cash flow yield, the higher the indication for undervaluation. So first we're going to take the free cash flow from 2024, 0.38 billion. We're going to divide it with the current market cap, 4.83 billion. And then we're going to get the free cash yield for 2024. So the number we're going to get would be around 7.86%. And that's a very good free cash yield actually. It's over the 4%, so it would be a check here, and we like to see that. We can also take a look at the future assumptions of the free cash flow. We can see here in 2025 around 357 million, in 2026 around 396 million, and in 2027 around 536 million. And I think these numbers could be realistic, so let's assume for 2027 the 536 million. Then we're going to divide it with the current market cap, 4.83 million. And then we're going to get the free cash flow yield for 2027 with our free cash flow assumptions. So the number we're going to get would be around 11%. And that's a very good free cash yield actually. It's over the 4% again. So this would also be a check here for 2027. And I think this is already something positive that we like to see. The next thing we're looking for is a debt to free cash flow ratio under 5. This means the company can repay the debt with the free cash flow in under 5 years. A very important number, because if a company has too much debt and cannot repay the debt, it can risk to go bankrupt. So first we're going to take a look at the long-term debt. We can see here 4.76 billion. Then we're going to add the short-term debt as well, and we can see here it's around 1.87 billion. Then we're going to divide these numbers with a free cash flow of 0.38. And then we're going to get the ratio that we're looking for. The number we're going to get would be around 17.44. And that's a very bad number actually. It means in over 17 years we can repay the debt with a free cash flow, and it's not a check here, and we don't really like to see that. We can also take a look at the cash on hand, how much money this company has in the bank, and we can see here around 1.28 billion. This is a decent amount, but overall I think this company doesn't have a good balance sheet because they have a huge amount of debt. The next thing we're looking for is the enterprise valuation to free cash ratio under 25. So this can also tell us about the valuation of this company. The lower the number gets, the higher the indication for undervaluation. So first let's calculate the enterprise valuation. This is the current market cap, 4.83 billion. Gonna add the debt, 6.63 billion, minus the cash, 1.28 billion. And then we're gonna get the enterprise valuation. So how much the whole company is worth. So the number we're gonna get would be around 10.18 billion. So now we're gonna divide this number with the current free cash flow. So this is around 0.38 billion. And then we're gonna get the ratio of around 26.78. And in my opinion, it's not a very good ratio. It's over the 25 that we're looking for, so it's not a check here. And in my opinion, it's not an undervaluation right now. But we can also calculate this number with the free cash flow assumptions of 2027. So the 0.53 billion. Then we're gonna get a different number. So the number we're gonna get would be around 18.99. And in my opinion, it's a decent number, so it would be a check here for 2027. It would be a small undervaluation, but only if they can reach the free cash flow again of 0.53 billion US dollar in 2027. The next thing we're looking for is shares outstanding decrease. This means the company buys back their own shares. So we like to see that, especially if the company is undervalued. So we're going to take a look here. We can see this company did a lot of buybacks, especially in 2018. It was over 10%, so a huge amount. As well in 2022, around 9%. But actually, this is not very good for this company because they have a huge amount of debt, so they cannot really afford to do it. But we can also see in the last 3 years, the shares outstanding increased, and this is because they have a lot of debt and the financials not look very good. So overall, I would say in the last 5 years it decreased, so it would be a check here, but it's not very positive to see that. Can Whirlpool stock be a good buy right now? The stock price is down around 65% in the last 5 years. So let's start with the positive about this company. To me, one of the only positive is the free cash flow yield of 7.86%. This is quite good, and in 2027, with our free cash flow assumption, the free cash flow yield could be around 11%. So now the negative about this company is the bad revenue growth in the last 5 years. It's declined. The bad free cash flow growth as well is also declined. The bad balance sheet. So this company has a huge amount of debt, and we don't like to see that. It can risk the company. Then right now we have the enterprise valuation to free cash flow ratio around 26.78. This is not very good actually. In 2027, it could look better of around 18.99. So we want to see that number under 25. So this would be a decent valuation, but only if they can reach a free cash flow of around 500 million in 2027. The dividend yield of around 3.99% is also quite decent, but we can probably expect the dividend yield to decline or the dividend to be cut in the next years maybe, because they have a huge amount of debt and they should pay the debt first. So overall, I think this company has a huge amount of risk. I would not really invest in this company, but if the free cash flow increase again, this company could also see some potential in the next years. If you found this video helpful, don't forget to like and comment and subscribe for more content.